Real estate sales volumes have completely crashed across Canada. And we are definitely feeling it here in Vancouver as well, where the May 2025 real estate sales volumes hit an all-time record low. It gets even worse when we talk about the pre-sale market. That segment is experiencing a complete and utter disintegration of sales. So this episode is all about the May real estate stats. We will uncover if we are getting closer to that cycle bottom or if there's still a long way to go. If you are interested in what's going to happen with Vancouver real estate moving forward, this episode is for you, especially if you are a seller in today's landscape. Let's dive in. We're going to start with what is happening in the Greater Toronto area because it is ultra fascinating on both the resale and the pre-sale or quote unquote new condo market. So new homes, again, the pre-sales in the GTA, well, they just experienced their 7th consecutive month of record all-time low sales. They are eclipsing what they experienced in the 1990s downturn. So to get tactical with the numbers, in April, last month, there were 310 total new home sales for the whole month. And that is down 72% from the year before and sits 89% below the long-term 10-year average. That is the worst April on record for new home sales in the GTA ever. When we strip it down to what's happening in just the condo units, because that was for all pre-sales, right, including detached and townhomes, etc. For condos, there were only 105 sold in the entire Greater Toronto area last month. That is down from like 4,000 in April that was experienced in the height of the bull market in 2022. And like the long-term average, if you want to look at sort of 10-year average, you can expect about 2,800 a month. So even at the long-term average amount, that is about a 96% collapse in sales volumes, just destroyed. In Vancouver, things aren't much better. According to the Altus Group, there were a total of 860 new condo sales for the entire first quarter of 2025. That is down from about 5,250 sales, again, at that sort of height of the bull market in Q1 of 2022. So that is an 84% decline. There's just blood in the streets, as they say. When we look to the resale market in Toronto, their inventory, it's surged, right? It's just lifting just like it is in Vancouver to essentially levels that they have not seen in decades. According to Treb, their real estate board, May active listings hit basically 31,000 last month, which is an astonishing 42% increase from the same time last year. It represents, not too shockingly, the highest May inventory level on record, rivaled closely only by May 1995, which was the height of that 1990s housing downturn I mentioned earlier. That led to basically 2 decades of stagnant price growth in real terms. So while buyer activity remains clearly muted, sellers are entering the market in increasing numbers. New listings are up like 14% year over year to like 22,000, one of the busiest Mays on record, second to only 2017 that saw a flood of inventory come to the Ontario market right after the foreign buyer tax, which triggered a whole bunch of people wanting to offload their properties and correlated with declining home values right after. So this imbalance that they're experiencing in the GTA between supply and demand, it drove the sales to new listings ratio, the SNLR as it's acronymed, down to 28%. Okay, so what does that really mean? Well, it's a steep drop from 37% from the year before, but that 28% ratio, it means the market is firmly in buyer's territory. And that's where downward pressure, typically follows. It's also the lowest May sales to new listings ratio on record. So we're talking about all these records being smashed to the downside. And it's an especially notable trend during what is usually, it's peak season, right? April and May, those are peak seasons for real estate sales. And we are seeing the exact opposite happening. Bit of a curveball here. Interestingly, despite the surge huge in inventory and the absolutely subdued demand, prices ticked up in May. The composite price, the benchmark price, it rose about 0.3% month over month, about $3,400. It's now sitting at $412,800 for a home there. And, but let's look bigger picture, because prices are still down about 4.5% compared to this time last year. But very odd to see prices tick up in this type of landscape. Again, I think it's like what we talked about a couple of weeks ago, where it's quite simply what is selling are more detached, more townhomes, more nice condos. The one bedroom, the studio condos at obviously a lower price, those simply aren't selling right now. So the overall prices are ticking up. That's my best educated guess as to why they're actually seeing any type of even minor price increase there. Anyway, whether that signals a turning point or simply a pause in the broader downtrend of prices, of course, that remains to be seen. But with inventory building and buyer hesitancy remaining, well, the months ahead will be very telling.
Holy cow. Following that up, that's quite some news. I mean, Dan, at the end of the day, like you said, the properties that are selling most likely have a high degree of utility. They are rare. They have some form of scarcity. When you have that low of sales volumes, then you have a very small data sample size, and it's likely it's expensive property, a really nice property that's actually selling. A lot of this lower degree utility, speculative development, this is the problem that they're facing. And when you look at the BOC, we have to consider that interest rates are one of the largest drivers of real estate values. The lower the rates, the higher the sales. It's got an inverse relationship. And on Wednesday, the Bank of Canada announced it was holding its key interest rate steady for the second time in a row, maintaining the overnight rate at 2.75%. And this marks a continued pause in the monetary policy, and clearly a pause in real estate sales volumes. The bank cited stronger than expected inflation in April, and survey data showing household inflation expectations are rising due to tariffs and concerning trends in the evolution of inflationary pressures. While we know with a high degree of certainty that trade wars are stagflationary, they slow growth and they raise prices. What we don't know yet is how severe this trade war may be, or even if it'll end up materializing beyond what it currently is. For Vancouver's real estate market, this decision reinforces what we've already been seeing: a prolonged period of elevated borrowing costs, continued buyer hesitancy, and an overall market stagnation. The halt won't help the overall sentiments, certainly, and will leave the market to continue to grind to further record low levels of sale volumes. We are already seeing an impact of uncertainty in a slower labor market and slumping home sales. Unfortunately, we are also seeing a pickup in underlying inflation, with core measures of inflation registering above the 3% threshold on a 3-month annualized basis in recent months. That combination of slow growth and rising inflation puts the bank in a tough spot. Given rising unemployment and risk of a wider downturn, we still very much believe the Bank of Canada will lower its interest rate at least one more time this year, if not two, but likely at the next meeting on July 30th. As we know, a lot can happen between then and now.
So I want to share an update on Condo Day. We talked about that last week. And if you missed that episode, check it out. But the debrief is essentially that a developer that pre-sold a condo tower in Surrey about 4 or 5 years ago, well, they held back apparently about 78 units. And now that the building is complete, they're offloading them. Very aware of how price sensitive the current marketplace is, they created a bit of a marketing campaign and tried to build up a frenzy by knocking the price down 25% below what they sold pre-sale. And they had to do this one-day blitz, get everybody through, blow them out. So what was the result? Did it pan out? Is 25% off pre-sale numbers the right number to sell product in today's landscape? Because obviously the status quo is very grim and very low sales volumes. So this is what happened. Approximately 200 people showed up, somewhere between 150 and 200 people showed up for this sale, at the door before they opened it up. And while it was dubbed Condo Day, ended up that not all units sold in that one day. Sales continue up until now. It's now June the 5th. We're recording this on a Thursday. I am one of the agents that was included, in the chat group created by the marketing team. And so I'm getting these sort of real-time updates. As of June 2nd, it was estimated there's about 9 units remaining. According to the chat group today, I mean, they don't say exact numbers, but I would say it's probably still at least 7 or 8. So, even at 25% off, the demand was obviously really good, but, it wasn't overwhelming, right? It's not like they blew out all 78 units and had another 200 people in waiting to try and get the same units. So today there's still units available. Now, Zonda Urban released some details about this sale, and they stated that the 78 units released combined for a blended average of $821 a square foot. Compare that to the original release price of $847 a foot for blended average. And if you're not familiar with the term, so blended average basically means, well, you're going to have, at the very bottom, you might have a 1-bed condo at $1,000 a foot. And at the very top, you might have a 3-bedroom at $800 a foot. And they take all the prices combined and blend it out to the blended average. Hopefully that made sense. Anyway, so to go from 847 at pre-sale to 821 now, I mean, that's only 3% off, not 25%. Now, don't get me wrong, and don't freak out here, but I mean, I'm pretty certain by the marketing and everything I saw, there was absolutely a number of units at 25% off, right? They weren't misleading. There were those deals that existed. Though, it is important to know your numbers, right? Because again, maybe there were a few units that were sold closer to pre-sale prices. I wasn't there. I didn't see final prices. Don't sue me. But, this is coming from a very reliable source. But either way, if such a sale takes place in the future, or any purchase, of course, work with a professional and truly know if the marketing campaign around the numbers equals true market value, for example, or ideally below market value if you're buying at a sale. Just as an FYI too, if and when all 78 units do sell out, there was a projected $43 million in sales. So, they're clearly selling a lot more product than most developers in this landscape. And so kudos to them. I think they created a strong campaign that has results. Could they have sold for a higher price in 2021? Yeah, I think so. Either way, right? They rolled the dice. Here they are. But I thought that was an interesting update to share with everybody.
Kind of reminds you, Dan, to read the small print. Ultimately, let's touch on GDP here, because in the first quarter of 2025, Canada's economy, and I say this in parentheses, expanded at an annualized rate of 2.2%, surpassing whatever those expectations were. Much of this growth, though, was due to companies stocking, I think, higher levels of inventory driven by looming tariff threats. So they were buying, they were front running the news that they knew was coming. And this growth was primarily driven by a surge in exports, notably in passenger vehicles and industrial machinery, all the stuff that was going to get tariffed going back and forth 7 or 8 times across the lines, as businesses accelerated their shipments ahead of what we thought, right? So, domestic demand, though, this is important. It remains weak, with household spending growth slowing to 0.3% and residential investment declining by 2.8%. And this is largely due to a significant drop in all of this resale activity as well.
I wonder if the top line information is what the BOC based some of their decision to hold rates on. I mean, I don't think so. They have more data than any of us ever will have access to. But, you read headlines like that. It's like, oh, yeah, the economy's fine. We'll just keep rates where they are.
I wonder, too, if they're anticipating that the economy is going to get quite a bit worse before it gets better. And so holding the rates where they are gives them room to come down to try and rescue the economy if it gets quite a bit worse. If they keep coming down now and it keeps getting worse, it's going to be harder and harder for them to create stimulus. So I think this is part of their plan. But again, so much of this is going to depend on the US GDP too. And, Trump was out there yesterday calling out Jerome Powell to lower rates, right? So here we are.
So we talk about housing affordability a lot because it is so important and it is top of mind. And the multiplex plan, right, C44, C49, they're going to try and Bill 49, like Bill 44 and Bill 49, those are here to help bring gentle densification to our cities. And of course, the TOAs will get a much higher density. But there was a recent development that we wanted to share from the city of Burnaby. Now, Burnaby's already considered the most pro-growth, especially for the multiplex plan. They've removed the requirement for a development permit. You can go straight to building permit, which saves time and money. Well, this is a update that came just this week, and it comes from the civil department or the engineering department. And I'm just going to read a bit of this email for you because this came from a colleague who is working on a multiplex lot for his developer. Quote, to support housing affordability and streamline the permitting process, the City of Burnaby's engineering department will suspend the requirement for future works offsite improvements for building permit applications in the R1 zoned areas. So this means the civil drawings for offsite improvements will no longer be required. Please note that any offsite servicing deemed immediately necessary to support your development, as determined by engineering, will continue to apply. Okay, so what does that really mean? If you are putting a multiplex, if you're putting 4, 5, 6 units on a lot that previously had a single family, quite often the city will say, look, we need to improve our infrastructure, right? Our sewer lines, our water lines, etc., to be able to support more people on that same lot. And what this is saying is, well, maybe you don't have to anymore, or ultimately what they're going to do is fund those infrastructure upgrades from other means and not charge the developer further fees. Hallelujah, right? This could save ultimately up to maybe $250,000 per multiplex, right? This is what we budget in pro formas. And if that amount is reduced dramatically or even removed, I mean, understandably, a portion of that, a large portion of that, should ultimately pass through to the consumer, right? The developer is still going to make their profit, and they can bring product that's going to be more appealing at an end price point to the consumer. So that's fantastic. And to kind of complement this, we just picked up a lot for a developer in Coquitlam. And of course, we had budgeted $250,000 for the offsites and the improvements there. Civil engineer came back. The quote was actually $90,000. So, when you're talking about $150,000, $160,000 swing on your pro forma before you've even broken ground, this incredibly increases the viability of a project, and again, potential savings for the end user, right? We're talking upwards of if that's a 4-door project, right? So we're talking about $40,000 a door. The price is just reduced. I mean, that's immense. So anyway, a bit of good news here, and very thankful that Burnaby is being so pro-growth and finding ways to help developers bring homes to market by reducing their overhead.
I also think we're going to need a lot more of it when we head into the future here. And this next story is a reason why. So get this, more Canadians are carrying a mortgage into retirement. And I think this is a spotlight on the economy. So here's a glaring example of how housing unaffordability is affecting everyone. More Canadians entering retirement with a mortgage than without one. A new report from Royal LePage reveals that nearly 1 in 3 Canadians planning to retire this year or next year will still be carrying mortgage debt into their golden years. It's a dramatic change from earlier generations. As an example, back in 1999, just 8% of retirees had a mortgage. By 2016, it was 14%, and today that number has doubled. Royal LePage CEO Phil Soper put it bluntly. The idea of burning your mortgage before retirement used to be a rite of passage, and now it's somewhat of a luxury. He notes that boomers are retiring later, living longer and staying active well into their 70s. Retirement is no longer a clear finish line. It's evolving into a new phase of life, very different financial realities than what existed a decade or two before. And so what is driving this shift? Well, it's affordability. At least it's one of the major factors. Boomers, like everyone else, are dealing with a high price market too. And many are holding on to large mortgages longer than they had anticipated. The age of first-time home buyers has also crept upwards quite dramatically, increasing the odds that future retirees will be paying off their mortgage well into their 60s, possibly beyond. Nationally, the decision to downsize or stay put is still fairly split. 44% of agents surveyed said it's about an even mix. But in high-priced markets like Vancouver, it's clear that many are opting to stay in their homes for longer, often because they have to, not just by choice. The bottom line is the definition of retirement is changing. At least it is in Canada. And it now includes a mortgage payment. And in my perspective, This is a sign of an economy in trouble, mostly because the young people in our economy cannot afford to support the backside of our economy. And it's just, when you've got people who have had, their home's worth $2 million and they're trying to downsize and they need to sell to a younger generation. That younger generation can't afford to do it. And so what happens is that transfer of wealth. And then before you know it, there may not be enough for retirement. Hence the mortgages.
So the people with mortgages, are they even paying them or are they falling behind? And we have a very interesting and ultimately surprising update about the arrears within mortgages in Canada. So the mortgage arrears rate in Canada, it actually improved in March of this year. March is the most recent data we have. It lowered from 0.23 to 0.22. This is the first improvement we've seen in this metric dating back about 1 year. The last time it improved was April of 2024. The improvement was led by noticeable drops in arrears rates in the following provinces: the Atlantic region, Quebec, Manitoba, Saskatchewan, and Alberta. They're all improving dramatically. Ontario remained at the same as the month before at 0.2, and BC actually increased from 0.19 to 0.2%. I love making references to history, so let's look at this one. So for reference, the highest amount of arrears ever in Canada was 18,702, which happened in January of 2011. Today, the total amount of arrears is 11,003. That is a 42% reduction since 2011. Now, obviously, it's gone up and down, blah, blah, blah. But again, to show that today in the landscape we have, the home prices never being higher with relatively high interest rates, Canadians continue to pay their mortgage, and we still see no real stress in the arrears rate.
Yeah, I think for over that time period too, Dan, there's been a lot of equity that's been made in property. So there's a lot of protection. I mean, it's dwindling, sure, but people are still right side up in many instances. Let's look at the U.S. market here, U.S. housing market, because I'm always amazed at how many similarities there are in the market cycles between Canada and the U.S. And just before we dive into the Vancouver stats, check out this info from our friends in the South. After years of intense bidding wars, record-setting price gains, and a distinct seller's market, the balance of power in the U.S. real estate may be finally shifting. A new report from Redfin revealed that the largest gap on record between the number of home sellers and active buyers. As of April, there were nearly 500,000 more sellers than there were buyers across the U.S. This is the widest disconnect since Redfin began tracking the data back in 2013. This shift doesn't mean that homes are suddenly affordable, far from it. In fact, the median sales price hit an all-time high in April of $414,000 despite waning buyer demand. What we're seeing instead is a market showing signs of fatigue. Elevated mortgage rates, which are hovering just under 7% for a 30-year fixed loan, are keeping many buyers on the sidelines. Add in economic uncertainty, stock market volatility, and inflation concerns, and it's no surprise that 75% of U.S. buyers are waiting for prices and rates to come down, according to a recent Bank of America survey. So Redfin's research indicates that we haven't seen this many home sales since March 2020, nor this few active home buyers since the early pandemic freeze in April of that same year. It's a strong signal that inventory is building faster than demand, and prices, they're likely to follow. While home values have remained sticky so far, Redfin's economists are projecting a 1% price correction by the end of the year. So why so modest? Well, simply put, sellers have options, kind of like I just mentioned before. They have a lot of equity. So unless they're forced to sell, many will stay put if they can't get their price expectation. And on the ground, U.S. agents are already seeing longer days on market, price reductions, and an uptick in seller concessions, behaviors that would be just unthinkable a year or two ago. So the key takeaway, we're entering a more balanced market on both sides of the border, and sellers who adjust their expectations early could have a major advantage.
I'm always amazed by how similar Canada and US real estate can, as a whole, can emulate one another, even with sort of dramatically different circumstances and things like 30-year amortized mortgages. But they do work a lot in lockstep. So there you go. That's what's happened in Toronto and in the States. So now, our final segment, we're going to dive into the June stats for Greater Vancouver because they just came in this week. And let's start off, as we always do, with sales volumes. And as we mentioned, it is not the health of the market, it is how sick the market is, because we only saw 2,228 units sell across the Lower Mainland last month. As mentioned, that is the lowest on record, dating back 21 years is how far the stats are collected from. It's like 19% lower than last year, which was obviously a slow year. And we're like 31% below the 10-year average. I am omitting May 2020. Yes, it was lower. Yes, you also could not leave your house, so nobody was buying. But ultimately, I mean, if we're hitting record lows here, this is an extreme case of low sales volumes. It's safe to say that, you know, if you are a seller in this market, and you get an offer, it needs to be taken very seriously. Buyers obviously have never had more options than today, and they're also never been more scarce than today. I mean, if you look at the ratio, for every buyer today, there are 9 sellers. 9. So if and when sellers, you're on the market, you get an offer outside of any silly lowball, if you get something reasonable, you are going to want to work with that buyer because there's a very high chance they are the buyer for your home.
Very good advice. Let's take a look here at new listings. 6,640. That's a 4% gain over May of 2024. That's 9% above the 10-year average, but a little lower than April 2025 by about 240 listings. Interestingly, this is the second straight month in a row of declining amount of condo listings compared to the month prior.
So obviously that means inventory is stacking up. And of course it is. When all the listings were pulled off the market at the end of the month, we washed out at 16,535 total active listings. That's up 26% year over year, but 46% above the 10-year average. And we're currently sitting at like an 11-year high in inventory. So buyers have more choice today than they've had dating all the way back to July of 2014. Now, of course, a lot of people will relist again at the beginning of the month, right? This is June now. There's going to be a lot of Hail Marys probably thrown this month because once we hit July and August, you know, very good chance that we are going to see a continued slowdown as we typically do in the summer. But, you know, behind or following another no rate cut decision, I think summer is going to be definitely slow. So you're going to have a lot of people really pushing to get their homes sold in June. And right now, as of Thursday, June the 5th, we have just crossed once again the 18,000 active listing threshold. There's a lot to choose from for buyers.
One might argue that we're already in the summer market. With that said, let's look at sales to active ratio. The overall sentiment in the marketplace here. Overall, we're sitting at 14%. That is up 1% month over month. And this has been one straight year of a balanced marketplace. When we break it down by asset class, we're looking at detached homes. It's the same as last month, 10%. Townhomes, the same as last month at 18%. And apartments, the same as last month at 15%. So very, very balanced, and clearly there's very little urgency in the marketplace.
So what's going on with foreclosures? Are those spiking? Well, they are increasing. They increased by 16 just last month, and we're sitting at 305 total. So when we started tracking this, it was October of last year when there was 230, right? So you're like, okay, 70, 75 more. That sounds like a lot, right? That's 32% more. Is that really a huge number? Well, if you look at it in only that context, yeah, that's a big lift. But of course, you have to look at it compared to all listings overall. And so back in October of 2024, there was 0.015% of the listings were foreclosures. That has increased to only 0.017%. So when you look at it holistically, it's not a huge jump. But again, there is 32% more than October of last year. So they are increasing, though again, they're such a marginal part of the overall inventory, but always fun to track this and potentially create some opportunities for people that want to pick up a court-ordered sale.
Yeah, when we take a look here at how long those properties are taking to sell, the average days on market here is up by 1 day, sitting at 17 days on market.
That's for sold homes. And I wanted to add something here because we've not been sharing this historically. So yeah, sure. It takes 17 days on average to sell, which, as a seller might sound great. Okay, cool. I can sell in 2 weeks. Waiting 2 weeks is not a big deal. That's for homes that are actually sold, right? This does not include homes that, let's say, were listed for 4 months, relisted, 10% lower, and then sold in 2 days. That number is excluded. But one thing I wanted to share today is, what is the average days on market for homes that haven't sold that are still sitting on the market? Well, if we go to condos right now, which we know are the slowest to move, the average time on market without selling is 61 days. That's 2 months. So while, it sounds exciting that you sell in 17 days, well, you don't sell in 2 months if you aren't priced right, if you aren't marketed right, if your realtor isn't giving your listing the right exposure and attracting the right buyers. So just an important number to reference. So let's close on price now. Because you've probably heard HPI, it did decline in the month of May, and that is the second decline and second in a row that we've seen in 2025. Prices, as measured by the HPI, dropped about $7,000 or 0.6% month over month. So if you go out and you want to buy the sort of quote unquote average home, the price today, $1,177,000. When we go year over year, we're down. We're down about 2.9% from this time last year. So not a dramatic amount, but absolutely we are lower than we were in May of 2024. As we like to break down the other prices, let's take a look at median. It is up for the 4th month in a row, up 35,000 just last month. Median prices are sitting at $985K right now. This is the highest reading of the year and actually a 12-month high as well. Interestingly, median is kind of the strongest price metric. It's sitting at only 1.5% below that all-time high. And lastly, we'll look at averages, which also increased up 51%, 1,266,000. Average prices are the highest they have also been in 2025, meaning we will likely see HPI lift next month, but again, very marginally. So Ryan, we are in June. You've kind of alluded that maybe we're already in the summer months, right? Are we going to see another record low sales volumes for this month? What's your take on what happens in June?
Yes, I think so. I think we're going to see a lot more of what we've already been looking at. There's, the Bank of Canada had an opportunity to lower rates here, and they didn't. And I wonder in 6 months from now if we'll be scratching our head asking why they didn't. I just don't see the progression of, we're getting higher and higher supply, stagnant interest rates. We're headed into stagflation. And that means that, like you just mentioned, median and average prices are up because there's just a few amount of properties that are selling, and they're typically the higher value properties or a higher degree of utility. The vast majority of the market is not moving. And if you look at home price sales down 2.9% year over year, if we enter a period of stagflation, you could see five years of price stagnant, and that could be lower, it could be higher. It's just in my mind, I just don't think we're going to see a return to what we've been used to historically for some time. And I mean longer than the summer.
Likely, for sure. Yeah. Real estate is a slow moving enterprise, and, 1 or 2 more rate cuts are not going to result in a significant change in the market in the short term for prices or sales volumes. So the grind continues. I think we called it a grind at by the end of the year. Thought this year would grind out, and it's exactly what's happening. Slower than I think many thought, but it is the reality in front of us. So again, sellers, you got your work cut out for you. Buyers, enjoy all of the inventory that's available. It's nice to have choice. And again, sellers take offers very seriously if they do come your way, because they are few and far between. Thank you, as always, for tuning in. We really appreciate you watching and listening. And if you want to share this with one person, we will personally send you our gratitude through the ether. Okay, so have a wonderful weekend, and we will see you here next week. Bye.